All right, let's talk about the stock market. If you've ever felt like it's some kind of complicated secret club, I'm here to tell you it's not. Today, we're going to break it all down step by step, especially for all of you in India who are thinking, okay, I'm ready to get started. So, let me ask you something. Have you ever looked at your savings account and just thought, is that it? Could my money be doing more? Well, that's exactly where the stock market comes in. It's not just for the experts, it's a really powerful way for you to build real long-term wealth. Okay, so here's what we've got lined up. We'll kick things off with the absolute basics. What even is the stock market? Then we'll get into why prices move around so much. We'll look at your best options for starting out, how to manage risk like a pro, and some common mistakes to avoid. And we'll wrap it all up with this simple guide on how you can get started. Sound good? Let's dive in. All right, first up, what is the stock market? Let's get right down to the fundamental idea. You know, the easiest way to think about it is like a massive marketplace, like a sabzi mandi. But instead of buying and selling vegetables, people are buying and selling shares. Now, a share is just a tiny, tiny piece of a company. So when you buy a share, you're not just clicking buttons online. You are literally becoming a part owner of that business. How cool is that? Okay, let's use an example to make this super clear. Imagine there's a company, let's call it GEPL Capital. Now, GEPL Capital wants to expand, maybe open new offices. To get the money for that, they can sell off tiny slices of the company to people like you and me. So GEPL Capital issues these shares, you decide to buy one, and boom, just like that, you own a small piece of the company. And here's the magic. If GEPL Capital does well and grows, the value of your little piece, your share, can grow right along with it. Your success is tied to their success. So where does all this trading happen? Well, here in India, it's mainly on two big official platforms, the NSE, which is the National Stock Exchange, and the BSE, the Bombay Stock Exchange. And the important thing to know is that these are regulated places, which means they make sure all the trading is fair and above board. All right, so now we know what stocks are, but the big question everyone has is, why do the prices jump around so much? One day it's up, the next it's down. Let's dig into what's really going on behind the scenes. Well, a stock's price can change for a bunch of reasons. Sometimes it's about the company itself, like if they had amazing sales. But a lot of the time, it's about the big picture stuff. Think about the overall economy, what's happening with interest rates, or even things happening on the other side of the world. I mean, we've all seen how a change in oil prices can affect everything here at home, right? It's all connected. And all of this together is what people call volatility. It can seem a little chaotic, for sure, but here's the little secret. For smart investors, that up and down movement isn't something to be scared of. In fact, it's where the opportunities are hiding. Okay, let's get practical. You're thinking, I'm ready to start, but what are my options? Well, the great news is there are some really simple ways to get into the game. Basically, you've got three main paths to choose from when you're starting out. First, you can buy individual equity shares. That means you pick the companies yourself. It's higher risk, but you're in direct control. Second, there are mutual funds. This is where you give your money to a professional who invests it in a whole bunch of different stocks for you. It's a great way to diversify. And third, you've got index investing. This is like betting on the whole team instead of just one player. You invest in a fund that tracks a major index, like the Nifty 50, and your investment just grows with the overall market. Now, listen up, because this next part is maybe the most important thing we'll talk about today. It's all about managing risk. You see, you can't avoid risk completely, but you can learn to handle it smartly. It's a basic rule of life, right? Higher returns usually mean higher risk. That's just how it works. So the real question isn't, how do I find something with zero risk? The real question is, how do I manage the risk I'm taking? So here's how the pros do it. First, diversification. You've heard it a million times. Don't put all your eggs in one basket. It's true. Spread your money out. Second, play the long game. Don't freak out every time the market has a bad day. Third, and this is a big one, keep your emotions in check. And finally, stay informed. Make decisions based on research, not on some random scary news headline you saw. Look, if there's one thing you take away today, let it be this. This isn't about chasing some get-rich-quick scheme. The real goal, the smart goal, is to build real, lasting wealth slowly and steadily, over time. Okay, let's flip the script for a second and talk about what to avoid. I want to help you sidestep some of the classic mistakes that trip up so many beginners. So let's look at the difference. On the one hand, you have the beginner traps, listening to some uncle's hot tip without checking it, selling everything in a panic when the market drops, and trying to be a genius who can time the market perfectly. It never works. The smart habits? Doing your own homework, staying disciplined when things get shaky, and just focusing on investing consistently. All right, we've talked about the what and the why. Now let's get to the how. I'm going to give you a simple 4-step plan to get you from thinking about investing to actually doing it. It really just comes down to these 4 steps. First, you need to open a Demat and trading account. Think of it as your wallet for the stock market. Second, and this is key, start small. You don't need a lot of money to get started. Just begin with an amount you're comfortable with. Third, focus on quality. Don't chase risky bets. Look for solid companies or good funds. And finally, step 4, just keep at it. Add a little bit consistently, and over time, you'll be amazed at how it can grow. And that really brings us to this one final, powerful idea. So many people get this wrong. The stock market isn't about timing things perfectly. It's about time in the market. The longer you're invested, the more your money can work for you. It's a tool for building your future, not a casino for gambling. So the only question left is, what's stopping you from taking that first small step today?